So you're thinking about buying a home? Well, in this video, we're going to talk about 3 things you absolutely must avoid before buying a home. And today I have a special guest, Megan Maloney with First Colony Mortgage, that will talk about those 3 things that you have to avoid. And trust me, you don't want to miss this, so stay till the end. So Megan, what is that first big one that you should avoid when buying a home?
Hi everybody, again I'm Megan Maloney with First Colony Mortgage. The first tip is don't change your credit. Don't buy a car unless you want to live in it. Don't change any of the big things on your credit. So always talk to your lender first before you're going to make any changes. Part of that credit piece is don't make any big changes like adding lots of money onto a credit card balance, even if it's a credit card you've had for a long time. We don't want those payments to change because that's going to be a big part of staying pre-approved as you're going through the home buying process.
So can people continue to use their credit card? You just don't want to put a large lump sum on it? Like continue their day-to-day use, right?
You're going to try to keep your credit this similar or almost exactly the same of what you've been doing. So if you're using your card and paying it off, you can continue to do that. If you have a little balance on a credit card or you have installment loans, we're gonna take all of that into consideration on your pre-approval. It's just new things, new big things that could be big payments that would make a difference in whether you stay pre-approved or it changes.
Okay, and what about if you have like a $5,000 credit on your credit card and you say, well, I just want to pay it off and that'll, free up my credit, that'll improve my credit. Is that true?
It can absolutely improve your credit, but you want to make sure you're asking those questions to your lender, because if you have, unless that $5,000 that you're paying off that balance with is extra money that you have, you want to keep your balances in your bank accounts the same too. Really, it's just going to be partnering the best way with your lender on how to stay approved if you're going to make big changes like that.
There's big things, the big statement is don't change your credit, but it's also very individualized to you, and that's why talking to the lender is so important. Now you mentioned not buying a car. What if you bought the car with cash? Like, is that a problem, or is it financing it, or is it again like, is that cash extra kind of thing?
Right, so that's going to be the same sort of scenario of, is that money extra? You're going to have your credit, that's going to be one thing, and then the money that's in the bank that you're using for your down payment and your closing costs, the cost of the loan and the cost of the transaction. So you don't want to make any big changes in that unless you know it's not going to affect your pre-approval.
Okay, perfect. So that's number 1. Don't change your credit. Just don't do it.
Right.
Okay, what is number 2, the big number 2 to avoid?
Don't change jobs. Don't quit your job. Don't go from a W-2'd employee or where you work for someone to a self-employed or 1099. Those are some of the biggest differences in a loan approval. Is we've got to verify your income, and if you make a change to that, it doesn't always mean that you can't still move forward or you're not pre-approved, but it totally changes the application, and we've got to verify all of that. So it doesn't mean that you 100% can't move forward, but it is a big change to the loan application and your pre-approval. Just like the credit stuff, we're basing your approval off of the information that we have, and we have to look backwards and be able to prove the stability moving forward is what we're analyzing to make sure that you're approved. And so don't make big changes to your job either. Don't quit your job. Don't change jobs. If you are changing jobs, great. We just want to verify that and make sure that the pay is either going to be the same or more.
It's changing from like a W-2 job to another W-2 job. Okay, as long as it's, like you said, same pay, same type of work.
As long as we're similar, and we can, and even if it's not similar, like if you know you're going to change jobs, then we just want to be able to verify the new job with at least 30 days worth of pay stubs if you start a new job in the process, or if you are getting some big promotion, or you're just finished school and you're going into a new type of job. We just want to know all of that up front to make sure that your approval stays good.
Perfect. So don't change jobs. And if you do, talk to your lender. Always
Right.
talk to your lender, talk to your realtor. I mean, we're here to help. We want to rope us in so that we can be in your corner to help you navigate every part of the process. And you'll be surprised. People think like, I got a better job. I'm just going to be a 1099. We're like, oh, wait, hold on. Let's talk about that for a minute because that could change some things.
So going from being an employee or a W-2 employee to 1099 is huge. If you go from 1099 to W-2, that's easier to navigate because if you're 1099, you are self-employed. So if you go from, I mean, this is a case that happens to a lot of people. They do work that could be contract work and they flip from a W-2 to 1099 because they can make more money either per hour or per job, but that makes you self-employed. So you have to have 2 years worth of tax returns to be able to use that as a 1099 or self-employed person. That's a big deal because that means when you were W-2 for the same company for 2 years, that job history is great. But if you, same employer, go from W-2 to a contractor, 1099, we can't use the 2 years worth of employment as W-2. We've got to see your tax returns that you file self-employed because your employer's no longer collecting your taxes through your W-2. You're going to file that self-employed. And as a self-employed person, you have a lot of opportunity to deduct things like your car or any expenses that may come with your job, which can take your taxable income down. If you are self-employed, even if you go from in the exact same job, W-2 to 1099, we have to have a 2-year history of being self-employed because you can make $100,000 W-2 and $150,000 1099. But if you have a good CPA or if you do a good job yourself, you can write your $150,000 income down to 30. And we see that in a lot of self-employed people. Their CPAs do an excellent job at keeping their tax liability down, but that doesn't help them when they're trying to qualify for a loan.
Okay, so there's like different purposes. So I do have a real estate agent on our team who talked about how he doesn't want to do that. He doesn't want to write off anything because he's trying to buy a home. He's trying to show that his business is making more money, so he's purposely doing exactly what you're talking about.
Right. So this is where we can strategize. Again, it's like talking to your agent up front about things that are happening and your lender up front to make sure that you stay pre-approved when you're making these big life choices. Because it doesn't necessarily, I mean, we're talking about these as 100% don'ts, but life happens. If you have to, we want to make sure as a team that you understand what that's going to do to how you can move forward in purchasing a home.
Sure.
So,
yeah, that makes sense. I do have another question about that. If somebody is a W-2 and they can get paid overtime and say they're like, oh, I'm going to buy a house next month or in 2 months, I'm going to work 80 hours a week instead of the regular 40, can that approve them for more if their pay stubs are showing that they're getting paid a lot more?
as far as income qualifying goes, we have the biggest things that the guidelines are looking for, regardless of the loan type, is consistency and stability in that income. So we can use overtime income, we can use bonus income, as long as you've had at least a year's worth of receiving that kind of income, and then we're going to average it out. Just trying to add a ton more overtime in 1 month, if you haven't consistently worked some overtime, isn't necessarily going to help you, because we have to show that you've had at least some overtime in the last year. And even if you go from one job that you worked overtime to another job where you have the opportunity of so much more overtime, we can average that. But again, it is an average. If I'm just trying to front load as much overtime as I can get, that's going to help you as far as, obviously your paychecks are going to be higher, so you're going to have more money to save for your down payment or to put towards the transaction, but it may not make as big of a difference in the income that we can use to qualify you, because you don't have, I mean, if you haven't been working 20 hours of overtime per pay period for the year. It's an average.
Gotcha.
So
okay, that's really helpful. So it could help with like your closing costs and your down payment, but maybe not the overall how much you're approved for.
right, it doesn't exactly equate to the last pay period I worked 20 hours of overtime.
Okay.
We're going to go off of the last year. You've had X amount of dollars that you've gotten in overtime, and we're going to average that over 12 or 24 months, depending on the loan type.
That brings us to our last point, number 3, and it kind of goes into that. It's kind of a good segue, is where's your money coming from?
Right, which is huge. We need to be able to document where your money is, whether it's in the bank, whether it's in a 401k or an IRA, any liquid account. We have to be able to have at least 2 months of bank statements showing that money is sitting there and that you have access to it. If you're a person who has mattress money or you have cash in a safe at home, unfortunately, unless we can explicitly document that money, like from the sale of something, and then we need a bill of sale to prove how much the item was worth, get that money in the bank. I understand why people prefer to have some cash reserves in their safe or, hidden away, but cash is king in every other aspect of life except for with a mortgage. We're so, the regulators are so picky that we document every penny in the transaction. We need to see the money is sitting in the bank. So if you have cash and you want to use it for your home, keep it in your safe if you aren't going to use it, but if you want to use it for your home, get it in the bank. And it needs to sit in the bank for at least 2 months.
Okay.
For it to be what we call seasoned. That's the mortgage jargon, where we don't see that large deposit. Otherwise, we have to document it.
Yeah, and that actually happened to me recently. I had a client who they were ready to put in an offer on a house, and they said, I've got $10,000 for a down payment. And they said, we've been keeping this in this safe for a year for our house. And the lender and I looked at each other and we're like, oh no,
right.
This isn't gonna work. And so we had to put it in the bank and we had to wait.
Right.
And there were some other hoops we had to go through with their income. It turned out anyway, but you can't use that unless you're paying for the house in the entirety in cash, right?
Which is why I have a job, because most people can't spend, don't have hundreds of thousands of dollars sitting around, and shouldn't. Put it in the bank. It's safer in the bank.
Okay, perfect. Well, that's it for this video. That is 3 things to absolutely avoid when you're looking to buy a home, and that probably will never change. This is something that's been around for a long time. These are 3 really, really important things. And again, my name is Annika Wilder. I'm a local real estate agent here in the Eastern Idaho area. If you're looking at moving here, whether it's next week or next year, just give me a call, shoot me a text, or send me an email, and I'll be happy to help. We'll see you next time. Bye.